As a result, Congress wanted more individuals to buy real estate instead of real estate being foreclosed. They wanted individuals to buy real estate. So here I talk about the Housing Assistance Tax Act in terms of the first credit that was actually available, and this was under Bush's administration. And then where do I talk about Obama's administration? Here we go. American Recovery and Reinvestment Act. Here's where I talk about Obama's era tax breaks. So it's a bit different, but you may notice it's under the same section, Section 36 of the Internal Revenue Code. Again, this is specific to this assignment. Your assignment will not contain these code sections. You got to do your own work. But these code sections were relevant to my assignment. And again, it talks about phase out limitations, and then the next paragraph it talks about, you read the within the body of the legal discussion. I do talk about like over here, it talks about the recapture provisions. What happens if you pay it, you sell it within 3 years, you have to recapture it as income. And then, still different limitations for the credit under American Recovery and Reinvestment Act. So slight differences. So it did matter when they bought it either in 2008 or 2009. One credit is available 1 year, another credit is available the following year. And over here, the next section is the conclusion. Here's where I take a position, and I'm talking about the tax benefits, and it is advantageous for IMA to buy real estate. And then again, I just gave you a legal discussion. Notice that the conclusion doesn't really cite any section. You could if you want to, but over here it's just a conclusion. If you think about it, in terms of writing a paper, how are the papers split into? It's split into three different sections, right? And when you're writing a paper, it's your introduction, your body, and your conclusion. Same format here. Your introduction, that's going to be your facts and your tax issues, and your body, that's going to be your legal discussion, and you have your conclusion. So those are the three parts. You have your introduction, your body, and your conclusion. So I say that to say the following. It's actually pretty simple when you think about it in terms of writing. In the introduction, you're going to tell them what you're going to tell them, right? The body, you're going to tell them. And in the conclusion, you're going to tell them what you already told them. It sounds a bit funny, but that's actually the flow of a paper. Again, the introduction, you're going to tell them what you're going to tell them. Again, the introduction, you're going to highlight key facts. This is what I'm going to tell you. I want to answer these key tax questions for you. And then in the body, now you're telling them this is a detail. Here's your meat. Here's the sections of the Internal Revenue Code. And then your conclusion, you're going to tell them what you already told them. So try to approach it in that manner. Again, introduction, body, and conclusion. It's still the same format as any other paper. But you gotta use my format. Do not use the format that the book has. Similar format, but I just like my format better. Well, it's not my format. It's my preferred format. So that's on the legal discussion. So going back to here, the legal discussion. Again, we have only cite primary sources. Notice I did not cite any secondary sources. I'm not for you not to use secondary sources. You're more than welcome to use secondary sources. That's how I start some of my research. But you don't cite it as source, primary source of tax law. So again, only cite primary sources. So last week we went over different types of audits. Don't want to go over that today. In terms of the audit process, what I want you to take away when the IRS does the audit, he or she can issue a proposed assessment, or what I like to get is a no change letter. Again, no change letter, that means the IRS is not making any changes to your tax return. The audit ends there. Or a proposed assessment, that's the 30-day letter. The taxpayer has the right to appeal within 30 days, which is actually a good thing. If the 30 days expires or they're unsuccessful in the appeals, then the examiner would then issue or send a statutory notice of deficiency. That's a 90-day letter. The taxpayer has two options at that point. Now, once you get the statutory notice of deficiency, according to tax law, according to the code, your two options are either to go to U.S. tax court. Here's where you file the petition within 90 days from receiving the statutory notice of deficiency. You're not required to pay the tax. You just file the petition within 90 days of receiving that notice. Or option two, you can either file it with the U.S. District Court or the U.S. Court of Federal Claims. But with that option, you have to pay the tax first, sue the government for the money, and then pay the tax first, request a refund, and then file a petition to court suing the government for the money. But again, you got to pay the tax first, and then you're suing the government for the money. And then you go to appellate courts. We'll go over in more detail in the appellate court system actually next. Let's go, let me show you the book. So last session, I showed you, hold on. No, wait, it's wrong chapter. So last session, I showed you the illustration on, what was it? The illustration that contained the actual flow. But remember, the first three trial courts, U.S. Circuit Court of Appeals hears cases from U.S. District Court and U.S. Court and U.S. Tax Court. And then remember, U.S. Court of Federal Claims has its own appellate court. Again, U.S. Court of Federal Claims has its own appellate court. U.S. Circuit Court of Appeals hears cases from U.S. Tax Court and U.S. Court and U.S. District Court. That's what I want to show you, that illustration. Where is it? Again, chapter 2 is great. It gives you a lot of different options on how to do research. I don't remember what page that was on. I guess don't remember. Oh, it is. What's judicial system? Where is it? Hey, it's not searching. How about tax court? I don't think it's gonna look it up because it was an actual picture. And it's more towards the beginning, I guess. Where was it? Yeah, I thought it would be searchable, right? Where is it? It could be actually. It could. I think it's before that. So speaking of secondary sources, so many of you find secondary sources and you're reading probably. Oh, so it's right before this one. Oh, thank you. Again, it gives you different ways of citing depending on which, if you use RA checkpoint, if you use CCH, gives you different options. Okay, here should be the one before that. Thanks for looking into that. A lot of these sources, you don't really need to pay for it, but you should. There's a textbook version that has a paid subscription, or you can actually do research the old-fashioned way. And I'm going to show you how to do research the old-fashioned way in a little bit. Again, this is a good illustration. It gives you different ways of evaluating where you can take it. One thing I want to highlight here regarding where you should take it in terms of the court. U.S. tax court, these are it has former tax attorneys. So keep in mind that the technical knowledge in U.S. tax court is very, very strong in terms of tax law. So these individuals know their stuff. So if it's a technical issue that you want to argue and you believe that there is substantial authority that supports your position and it's a primary source, then take it to U.S. Tax Court. U.S. District Court and U.S. Court of Federal Claims. These judges are generalists. They don't have specific knowledge in tax law. They have general knowledge in tax law, but they don't have specific knowledge in tax law. So again, could be different reasons why you would want to take it to U.S. District Court or U.S. Court of Federal Claims. To be honest with you, it's usually just between U.S. Tax Court and U.S. District Court. There are some cases that do go to U.S. Court of Federal Claims, but they're very few. It's mostly between these two. So your option is U.S. Tax Court or U.S. District Court. Again, technical issue, U.S. Tax Court, and you believe you can win on a technical issue. But let's say you're not too sure on the technical merits, or you have doubt to the technical merits, or it's a lot of gray area, and you want to win over the courts by emotional appeal, or maybe political influence. You have some political influence that can be ruled in your favor. Then perhaps maybe the district court can be considered an option. Again, technical issue would be the U.S. tax court side. Can these guys know their stuff? Where U.S. District Court would be judges and generalists in terms of their understanding of tax law. And that's not to say they're going to rule in your favor just because they're not tax attorneys. Just difference in terms of strategy. They're still going to evaluate the tax law and the cases. All right, now going back, did I go to where's the little map? I think it should be here. Here it is. You guys see it? Here's the map. Again, oh, again, I want you to commit this illustration to memory. It's not even that complicated, but this is what happens after audit or after the statutory notice of deficiency. Remember, I said with the U.S. tax court, they don't have to pay the tax first as long as they file the petition within 90 days of the statutory notice of deficiency. U.S. District Court, U.S. Court of Federal Claim, these two, they pay the tax first and then sue the government for the money. Again, remember how I said the U.S. Circuit Court of Appeals listens to cases from U.S. Tax Court and U.S. District Court, whereas claims, more specifically, U.S. Court of Appeals for Federal Claims listens to cases from U.S. Court of Federal Claims. It has its own appellate court. And then again, ultimately, there's the U.S. Supreme Court. There's a lot of cases actually currently in the appellate process. Over here on the bottom, it does give you another section. It gives you the small case division. Every now and then, when there's a tax due of $50,000 or under, that's just the guideline they use. What they usually do, they try to settle with the taxpayer. It doesn't go to court. Actually, it's a settlement. That case alone cannot be cited as primary source of tax law because it didn't go anywhere. It didn't even get tried in actual court. Again, both sides actually settled, came into an agreement. That's the small case division. But that doesn't mean because it's under $50,000, it's automatically going to go to the small case division. That's on a case by case basis. Not all cases go to small case division. Some of them do, some of them don't. I've even seen cases, just $1,000 balance, $2,000 balance that went to U.S. tax court. There's actually a couple of famous ones that went to U.S. tax court instead of getting settled in the small case division. Again, it's not automatic, but it is a settlement. Note over here, I like the note that they made here, no appeal from this division. Because if you think about it, you're making a settlement here in the small case division. I sort of equate that, not totally, but this is similar to if it was a criminal case proceedings and you're taking a plea bargain. You can't really appeal a plea bargain, can you? So the same procedure in this case. You can't appeal on a settlement, an agreement that you have with the court. The same thing with the criminal system. You can't appeal an agreement that you have with the court. It's the same process. But if it goes to court system, the actual court system, then you could take it to appeals, even to U.S. Supreme Court. There are some cases that eventually get to the Supreme Court. But just like anything else, to even go to the Supreme Court. Very few cases in general, but it all depends on what they're trying to do in the process. All right, going back to different settlements we talked about here. They settle at exams, appeals, or collections. There's different options in collections. Remember, if a taxpayer owes, there's options there. Do not lie for the client. There's options there. You can set up an installment plan, do an offering compromise, or currently not collectible. Those are options. Again, there's also options in exams and appeals. Now, one thing I actually want to go back to the over here with the 30-day or the 90-day statutory notice of deficiency. This is how I'm going to test you. And this is how I want you to understand. This is how it works. It goes through the system. It gets audited first, the 30-day letter, the 90-day letter, and then from the 90-day letter, the taxpayer's options are only two: the U.S. tax court or paying it and suing the government, either U.S. District Court or U.S. Court of Federal Claims. What if I told you there was a third option? There is a third option, but this option, I'm only telling you this as, I guess, one of those tricks of the trade, so to speak. But this is option, but this is on a case-by-case basis. The third option is actually something considered an audit reconsideration. What an audit reconsideration, the taxpayer or the taxpayer's representative is asking the IRS to reopen up the case. So they're saying, even though the statute, in terms of appeal process has already expired, the 30 days expired, they already issued a 90-day letter. We believe we have additional facts, or we actually have substantial authority. You're looking at primary source of tax law that supports our position. You're introducing new facts, and maybe there's a case that ruled in the taxpayer's favor, and you're citing that case as authority. When that circumstance, the IRS has the option to open up the audit again. Again, that's at the IRS discretion. The audit reconsideration is at the IRS discretion. They don't always do it. It's on a case-by-case basis. But if you have new facts or new documentation, or documentation that you didn't have available before, or new case law, then you can request an audit reconsideration. Not always the best option. In some cases, it actually could be advantageous to take it to court. But keep in mind, when you take it to court, there is what's called hazards and costs of litigation. There's, of course, they can lose, and it can actually be more, or then there can actually be the cost of litigation itself would actually be more than just representing somebody in front of the IRS, which can be less work and not as much billable time. So that's on the audit reconsideration side. Again, just a side note, something that is possible, but don't always think that that's the best option. Go through the process. Go through the 30-day letter, appeals, and then in terms of the 90-day letter, see if tax court or paying and suing the government on the district court or U.S. Court of Federal Claims is a better option. But again, another option, and I did not include audit reconsideration here because I don't want you to think that that's always going to be an option, because it's a case-by-case basis, and it's also at the IRS discretion. And sometimes you can use settlements and strategies there. So last week we talked about that's certified public accountants, enrolled agents, and attorneys. Now, I also talked about a little bit about limited practice. These individuals can practice in front of the IRS, but it's limited practice. Now, specifically, what's available to limit practice? Generally, just basic issues on exams, limited to negotiation. You can't really negotiate too much there. You can't even take it to appeals in some circumstances. So again, it's very limited in what you can actually do. It's, again, limited practice. And these are the different situations or different, situations that you can represent yourself. One of the employees can represent the employer. Corporate officers can represent corporations. Partners can represent partnerships. Now, the last one, if you're not a CPA or an attorney or an enrolled agent, you can represent the client that you're doing the tax return for, but it's only limited to that tax return that you're preparing, and it's only limited into presenting the facts. Again, limited practice doesn't include the full unlimited rights to practice in front of the IRS. Again, it's just very, very limited. Now, one of the things that I did post, on Brightspace is Circular 230. Circular 230 does govern the practice of practicing in front of the IRS, or what's considered tax practice. I'll go over that in more detail in a few minutes. Operating divisions, don't worry too much about the operating divisions. Just wanted you to know what they are. Well, just to go over a quick overview in terms of if you're getting audited, where is it going to come from usually? Again, if it's dependents, itemized deductions, issues that don't really pertain to any business related expenses, that's going to be the wage and investment income division. If we have individuals that claim employee business deductions when they were allowed, or any self-employed individuals, partnerships, S corporations, and even some C corporations that have assets less than $10 million, is going to be in small business self-employed. Over the $10 million threshold and international businesses, that's the LB&I division. And then we have your tax exempt and different types for different types of entities. Now, in terms of the different types of audits that they do, this is not set in stone, but just to let you know, in terms of what's more common in each division, for the wage and investment, they do more correspondence audits, mail audits, because a lot of the returns that they're auditing there are just verifying facts, verifying filing status, verifying income, verifying certain deductions. So a lot of that can be done through, sending documentation through the mail, through correspondence. Not always through the mail, can always be fax as well. So again, a lot of these audits, correspondence audits, are done in the wage and investment division. Small business and self-employed, they have usually field audits and office audits. It really depends on, a case-by-case basis. It's a good mixture of the two. So office audits and field audits. So again, office audits, they want you to go to their office, to the IRS office. Field audits, they're going to your place of business or to your CPA, wherever you keep your books. Same thing for large business and international. However, what I will say about the large business and international division, I would say it's probably more the field audits here than office audits, but they do a combination of the two. Tax exempt government entities, it's all over the place. Office, correspondence, and then field audits and office audits, depending on the case-by-case basis. Statute limitations, same as 3-year statute limitations later of the due date or the filing date, except when you omit more than 25% of your income, then it's 6 years. No limitation for fraud. 3 years for refund, and guess what? The IRS has 10 years to collect. So the collection that the IRS has is 10 years from the assessment date. Oh, here's one thing I wanted to talk about. I don't think I talked about this concept last year. I talked about tax avoidance and tax evasion, but I didn't talk about joint and severally liable for married individuals and any equitable relief. But just what is jointly severally liable? I'm sure some of you heard that before. Can somebody tell me what that means? Joint and severally liable. It's applicable in partnerships and applicable in marriages. What does that mean? Anybody? Somebody? Anybody? Nobody wants to take a stab at it? Nobody? Nobody wants to take a stab at it. So it's sort of similar to, I guess, how can I say it? What his is hers, what hers is his sort of relationship. So the liabilities, after the marriage, I guess once the marriage becomes final, at that point, any liabilities are joint and severally due by each partner. So each person is responsible for the liability. So it's jointly and severally liable. That's very common in the partnerships. Again, the liabilities of a partnership is shared amongst the partners. Same thing with a marriage. The liability is shared amongst the two individuals that are married. So here's a scenario. Let me tell you this scenario. Somebody's going to say something. It's several. Okay, so let me give you the scenario. So in this situation, I'm getting married, and my soon-to-be spouse, she has back child support, or maybe she owes back taxes. For 2019, we got married in 2019. We're expecting a refund. What do you think is going to happen to that refund? Did I tell you that she owes back taxes, child support, student loans? What do you think is going to happen to it? Anybody? Who wants to volunteer and answer? I want you guys to participate. Take an educated guess. What do you think is going to happen to the refund?
Well, could it be used to pay back the back
Yeah.
taxes and child
Yes,
support? Even
exactly.
though it is a joint tax return, that's the joint responsibility liability.
Yeah, so that's a joint and severally liable. Uh, yeah, because yeah, it's we're doing a joint liability. So then, I guess one option doing would be doing married filing separate. Well, we file married filing separate. There's chances that we're not going to get a refund. So it's more advantageous doing jointly. But if you're doing jointly, you're absolutely right. The refund's going to be applied, even though it's her taxes. Our refund is going to be applied to her taxes. I don't think that seems fair. Doesn't seem fair at all. Well, yes, and I'm actually glad that I like having this discussion because that is so true. One of the things that people don't think about when they get married, they don't. I mean, it's of course you consider, the affection side of it. You're in love. You feel like you can, a future with this person. I get that side of it, but what about the other side of it? You're merging finances. You have a partnership. A marriage is an actual partnership, so you should also treat it like a partnership. A lot of times people don't consider the financial aspects of it. What I always tell people, always get a credit report of the person you're engaged to, or ask for personal financial statements. I say that in jest. I don't, I'm just kidding about that. I don't mean for everybody to ask for that, but it won't hurt. Maybe I guess better to put it in this terms. Ask for that financial information. Have an open dialogue with your spouse, because these type of discussions do come up. So let's say my wife never told me about the situation. We file our taxes, and guess what happens? The refund got applied to her taxes. We never talked about it. Now I'm gonna be upset. We could have avoided this whole me being angry, me losing my hair. No pun. Well, I lost my hair already, but in that case, how could we have prevented it? She should have communicated that with me. We would have planned. We still would have got married. We would have planned better in terms of filing the taxes. Yes, I should be aware of that financial effect. Whatever, there shouldn't be any surprises. In that case, now let's say the facts are different. Now my wife did inform me of this in advance. I'm aware of it, that she's going to, she owes back taxes, child support, any other delinquents. I still don't think it's fair, but it's best for us to file a joint return. I don't think it's fair that, what's due to us should be applied to her refund. Well, that's under tax law. It is fair on the jointly severally liable, but in this case, I'm going to request equitable relief as an injured spouse. I'm the injured spouse here. I'm financially injured because my refund, or the refund that's attributed to me, my portion of it, is going to be applied to her back taxes, to her back child support, or student loans, whatever it may be. I should at least get whatever's entitled to me. So in that case, what I'm going to file as an injured spouse when I'm filing the tax return. I'm the injured spouse. We're allocating the expenses, however we're going to allocate. If there's dependents involved, we're going to allocate the dependents. I get one, she gets another. However we're going to do it, but it has to, be fair and reasonable. In that circumstance, whatever is due to her, that amount is going to be applied to her back taxes, her delinquent obligations. Whatever is due to me, that's going to be applied to me. I'm going to get my fair share. So there is equitable relief, and this is done. The injured spouse is usually automatic. You fill this out with your tax return, and then the IRS sends you your portion. The injured spouse and the person who's actually committed the delinquent act, whatever is due to them, that's going to be applied to their taxes. So that's one way of it. The other option is the innocent spouse option. This is a little bit different because it's the taxpayer has the burden of proof to prove that he or she is innocent, and that's a very hard burden. Here's a scenario. So different set of facts. Let's say my spouse, we got married. We weren't, and this is where you really should be open with each other in terms of everything, finances, everything. Okay, so we got married in 2019. We got married. We were married for a couple of years. She left in 2020, and then I filed for divorce, abandoned spouse. Divorce was granted in 2021. So for 2019 and 2020, we did a joint return, or it's more advantageous for us to do a joint return. And we collected all the facts, or at least I thought I had all the facts, and I did the tax returns correctly. Little did my spouse tell me that she has income from an account that she has in the Cayman Islands. She has a Swiss account. She also has partnerships, K1s from this partnership, K1 from this S corporation, income and interest that she never told me about. So I filed my tax return without omitting all that. I didn't know about those facts and know about the income, so I didn't include it. Again, my spouse abandoned me. She left me in 2020, but we had enough time for her to sign the tax return. So jointly, we're jointly and severally liable for the tax liability. So in 2021, I got audited. My wife is nowhere to be found. We got audited jointly because we did joint tax returns. And it was actually a pretty automatic audit because we did not claim all the income. She didn't tell me about all the income that she was supposed to claim. But now they're going to issue the notice, the proposed assessment, the deficiency assessment as well. And whatever she should have been responsible for, I'm on the hook for it under the jointly and severally liable document. That doesn't seem fair, does it? Now, I actually told you the facts. It's not my personal situation, but these type of facts do happen a lot. And the key takeaways from this scenario that I told you, I was actually pretty innocent, right? I didn't know I didn't have any information that my spouse had income from a savings account or an account from the Cayman Islands, Swiss account, or K1s from a partnerships and S corporation. I didn't have any knowledge, but again, I have the burden of proof to show that. Very, very hard to prove. Again, very hard to prove. If the IRS rules in our favor, then in that case, they will split the liability again, or whatever. They'll go after her on whatever she's responsible for. But again, I have to find a way to prove that I'm the innocent spouse. Injured spouse is easier to prove. Again, it's usually automatic. You do that with the tax return. Innocent spouse is more a reactive measure. Injured spouse, you're proactive. You're doing it before you even file the tax return. You're doing it with the tax return. Innocent spouse, you're doing it after the fact because, again, during the fact you're innocent, you don't know about it. You do it after the fact, but you actually have to have the burden of proof to prove that you were actually innocent. Innocent spouse can actually also be claimed in court. It's not just limited through the IRS audit process. It could be, again, the burden of proof is to the taxpayer that's supposed to be innocent, but that argument can actually be raised in U.S. tax court or U.S. district court. But again, these are the different options that can be under innocent spouse. Injured spouse, there's a lot of cases, again, automatic that I've dealt with. Innocent spouse, can only think of two off the top of my head that I was successful in. All the other ones, again, the burden of proof is very, very high in terms of the taxpayer has to prove that he or she is innocent. Very hard to prove, so that threshold is very, very high. And again, a lot of times they rule in favor of the IRS. And sometimes they do. It's a case-by-case basis. So again, I'm not going to review the penalties. Just know when it comes to when a taxpayer owes, there's a lot of penalties they can pay. Failure to pay, failure to file, accuracy-related penalty, substantial understatement of tax liability. Even if you claim a refund that's not legitimately yours, there's a 20% penalty. So all these penalties can actually be, can be imposed on the taxpayer. The tax return preparer is also subject to penalties. Again, unreasonable tax position, willful and reckless conduct, aiding and abetting the preparation of a fraudulent tax return, failure to sign a tax return, failure to furnish the tax return to the client, and fraudulent claims on earned income tax credit. Now, this amount of $500 per occurrence, it does add up. So again, you don't really need that many for it to add up. It does add up. Even with just like 20,000 or 20 or so, you'll be paying a lot in penalties if you do the math. Again, that's per occurrence per year. So again, and a lot of this time they do. If you're doing fraudulent claims on earned income credit, then there's probably another credit that they're going to attach it to and hit you on that penalty as well. Something that I didn't talk about last week. This is what I posted on Brightspace today. So there's two standards. So what governs tax practice and what standards should we follow? And these are the ethics of professional standards that we have to follow. Again, this is just two of them that I cited. The AICPA has their general standards that we have to follow. That's covered in more detail in auditing class. But these standards are more specific to tax services. And then we're going to go over the U.S. Department Circular 230. In terms of the standards for tax services, the first one is tax return position. Again, you're not going to put a position on a tax return that's unreasonable. Again, if you go to unreasonable position, over here, they sort of follow this standard, in terms of how much authority do you have, in terms of substantial authority, primary authority, do you have that you're going to win? How confident are you going to win? And here, how it's usually evaluated. If it's more than 40% chance that you believe you're going to win, that it's going to be sustained by its merits due to your research, looking at a code section, regulation, and maybe some judicial sources, and you're confident at least more than 40%, then it's not an unreasonable position. You do have substantial authority. Where the unreasonable position comes in is where the 20% comes in. When it's 20 to 40%, as long as it's properly disclosed on the tax return, it's not, even though I guess it is considered an unreasonable position, but it is, disclosed. Again, when you're trying to weigh the facts, if it's 20 to 40% that you're going to win, properly disclosed, there's no penalty. And then in this case, you can make the same argument here as well. It's, again, if you're above the 20% threshold and it's properly disclosed, then it's not an unreasonable position. The next section, the answer to tax questions on returns. Again, this is where I want you to be specific and addressing questions on the return. Be very, very careful. Do not answer quick tax questions. Always answer it depends. Just looking at it from that standpoint. If it's in the process of doing the tax return, that's fine. It's pretty standard for you to answer questions, but you should always be when answering questions that's not within the scope of what you're being engaged to. And then in terms of the procedural matters, that's more on a firm by firm, how you're accepting cases, how you're accepting clients. Is there a review process? Just to give you a general, how we do things in my practice. Somebody else does the tax return. I review the tax return. Of the review process. A lot of CPA firms have at least that level of review. Somebody does a tax return. Somebody reviews a tax return that's prepared by the staff or prepared by one of the associates. The bigger firms have a more structured, more levels on it. They have the staff doing the tax return. They have a manager reviewing the tax return, and then the partner reviews the manager's tax return. And then maybe even the bigger firms have a quality control person reviewing the partner's work. Those are just basic procedural aspects in reviewing the tax return. This could even get into more specifics on accepting a client. Do you have them sign an engagement letter, or how do you communicate accepting the engagement? Again, something to look at on your own time. The use of estimates. To the best of your ability, you can use the facts, the documentations given by the client, the numbers. There's going to be cases, especially cases where they don't file tax returns for several years, where you have no other option but to rely on estimates. As long as those estimates are reasonable and fair, and there's some kind of support to it, there's a benchmark, something you can actually trace it back to, or you extrapolate this estimate somehow, there's some support to it. You can use estimates. Again, keyword is support. Number 5 deals with, this is actually a pretty interesting one. This is where there's the departure from a position that was ruled against the taxpayer, either in IRS proceedings or the court decision, but you're going to put it on the tax return again. It's sort of that type of deal. So let's say 2019, or let's say 2018, the tax return was being audited because of what should we audit? Let's say salary. They believe salary was unreasonable to the officer. They disallowed it in 2018, but now in 2019, again, similar set of facts. Let's say about the same set of facts. You're still deducting the same amount of salary in the 2019, the next year. Well, if you look at the facts, the IRS ruled against that position in the previous year. So now the new year, you're taking a departure from that position. The only thing with that, just be very, very careful. There's nothing to say that you shouldn't take that position. That's fine, so long as you support your position by substantial authority of tax law. And a lot of this can be just the way you interpret it compared to somebody else's interpretation. Again, but you got to evaluate the sources of tax law. Number 6 pertains to knowledge of an error. So this does happen a lot. If it's an error from your side, if you make the error, then you tell the client, well, now I got to amend the return. Pretty, straightforward. Then the client should tell you, okay, go ahead and correct it. Even if it's to the favor of the client, and if it's not to the favor of the client, you still got that responsibility to inform the client. Let's say 2018 tax return was prepared by somebody else, and I'm preparing 2019 tax return. Usually I look at last year's return or the last 3 years return just so I can see if everything's consistent, reasonable, and I'm not trying to find any errors. I just want to make sure everything is done correctly. And then there's also a lot of carryover numbers that we need going forward. So I find 2018 tax return to contain errors. Remember, that return was done by somebody else. What is my responsibility? Basic responsibility is just to inform the client. You're responsible for informing the client that there was an error in the tax return that was done by a previous person, and advise them that they should adjust it or they should amend it. Again, your responsibility is not to amend the tax return. Your responsibility is not to tell the IRS. Your responsibility is just to tell your client that there's an error last year, let's correct it. And try to get more billable work out of it. Again, if it's to the favor of the taxpayer, it's usually automatic. They'll say yes. But if it's not to the favor of the taxpayer, and let's say you amend the return and they owe money, you still got to tell them anyway. There's an error on your tax return. We got to advise you that you have to make a change to it. Again, number 7 pertains to giving advice. They're advocating putting it in writing, such as using a tax research memo, or sometimes just a simple email would work. But this talks about different ways of communicating advice to clients, and again does reference your primary source of tax law. Circular different sections. Section 1 pertains to governing authority of the practice. Now, practice has been, it used to be just before practicing in front of the IRS, that's considered practice. Now it's broader than that. Now it's anytime you talk about taxes and get compensated for it. And even when you don't get compensated for it, you're giving advice on or answering a question on social media. You're answering a question on through email, one of your clients, or you're answering a question at a bar. You're talking about tax law. You're considering practicing tax law, even if you're just talking about taxes. Now, can you get sued for that? Well, it's a case by case basis. I mean, there has been cases where somebody talk about casually, a certain tax position over a couple of drinks, and yeah, I guess technically there could be cases because you are considered practicing. You're practicing tax law in that case. You are giving tax advice. So just be very, very careful with that. Try not to give specific advice unless they're your client, unless you're getting compensated for that. And then the other option, restrictions related to practice before the IRS. What can they do? This talks about confidentiality. There's more confidentiality or privilege, I should say, when it comes to attorney-client privilege as opposed to accountant-client privilege. There is some privileged information. Of course, you can't give the IRS everything unless they give you, a subpoena for it. You can't disclose that information. There's still some, accountant-client privilege. But when it comes to criminal proceedings, then you should definitely get an attorney. And it talks about that in more detail in this section. You violate any ways of practicing, they could sanction you. This talks about the penalties that I mentioned before. Then it goes over the proceedings. If you're gonna, if they found that you violated, they want to discipline you now. General provisions. A lot of this is just common documenting everything type procedures. These are just best practices, I guess. Well, it's a little bit more than just best practices, but they call it just general procedures. I equate that to just a lot of general best practices and how to do natural tax practice. Again, if you're doing tax returns, you are still governed by Circular 230. If you're a CPA doing tax returns, and even if you're not, you should use the AICPA standards. Uh, just as a guidance in terms of what to follow. And if that doesn't work, how about the penalties? Look, use this as a guidance. You don't want to be hit with these penalties. You don't want your clients to be hit with these penalties. Again, and one of the things about advising clients in terms of errors, advise them of the penalties as well. Tell them that, well, there could be penalties if they discover an error or you discover an error. So that's what happens. And as far as just document everything, I guess. Have you ever heard of the acronym CYA? Sort of use that as an analogy. Make sure you dot all your I's, cross all your T's, have everything documented. You're doing research, have that documented. If you're collecting facts from the client, you're doing a tax return. I take notes when I'm interviewing clients. Take notes. Some practitioners even record their meetings. Actually, I know a couple that actually record their meetings, which I think that's a bit much. But to each his own. At the very least, take notes, take sufficient notes, document everything. If there's communication with you and your client, I prefer to have everything through email. Client sends me a text message. I usually tell them, why don't you send me an email with the same exact text message you just sent me? A lot of times the text messages get purged and get deleted, or sometimes you're updating your system, it gets deleted. And in terms of is that even considered authoritative when it comes to documentation, or is it reliable when it comes to with documentation? Text messages not so much. Emails have more. It's more reliable than a text message itself. So that's all for the first section. Second section about all right. So last week this is where we left off, figuring out somebody's taxable income. So this is where we're going to spend a lot of time on. But remember how I told you got to know this formula in order to go forward in class. This is the basic formula, not the first formula. The first formula is ignore it, I guess, in a way, because that doesn't really exist anymore. Second formula is what exists. Gross income. Everything is considered gross income unless there's a deduction that tells you otherwise. Minus your deductions for AGI, and then you have whoa. And then you have your gross income minus deductions for AGI. That equals your AGI, adjusted gross income. And then you have your two deductions. Deductions from AGI, which is either your itemized deductions or your standard deduction. And then you have your deduction on qualified business income. And that's something we're going to go over in more detail later, what is considered qualified business income. But at the very least, this is your formula. Remember, the key to takeaways: standard deduction and itemized deductions are deductions from AGI. Just keep that in mind. Last week, we went over filing status. I think it's best to better understand filing status. We're going to do problems in a little bit on the filing status. But just key takeaways: end of year test, for single and married. That's what dictates which head of household. Again, this is geared towards single parents. That's what it geared towards. Or if you're supporting your parents and you're paying for their household expenses more than 50%, that's head of household. Again, qualifying widow or widower, that's 2 years after your spouse passes away. And here are your standard deduction amounts. Basic standard deductions are given here. And then if you're old and blind, you get an additional amount. So again, 12,400, and let's say you're single and you're 70. So you get 12,400 plus 1,650. So that's how that works. In terms of who doesn't get a standard deduction, this is the one I want you to think of. Married taxpayers, if one spouse itemized, the other spouse has to itemize. So you're going to hear that a lot. Even in practice, you're going to hear that a lot. So if somebody's using married filing separate, or they tell you they're married, you got to ask them, married filing jointly or separate. They tells you separate. You got to ask for the social security number of the other spouse and their name. what that's going to do, that's going to tell the IRS, well, let's see if that person did a itemized deduction. If they did, and your taxpayer, your client takes a standard deduction, they're automatically going to adjust it to zero because of this rule. Section 63C6 talks about that rule. It's forcing it's forcing both taxpayers to itemize. That's what it's doing. If one person itemizes, the other one doesn't, their amount is going to be zero, and that's usually what happens. They're not going to say, well, wait a minute, you have state income tax of X, you have charity. They don't know. They're just going to assign the zero as an itemized deduction, and this is authoritative. Section 63C6 tells you that. What's the standard deduction if you're dependent? It's either 1,100 or 350 plus earned income. Again, the greater of those two numbers. We're going to go over on a couple examples in more detail in a few minutes. Dependency rules. I don't think we went over these last week, did we? But let's go over these. Qualifying child test, qualifying relative test. Now, even though the exemptions are not there, these provisions are still applicable in different provisions of the Internal Revenue Code. Qualifying child test. I want you to think of RASH, R-A-S-H, RASH. Here are your tests. Relationship. The taxpayers relate. What's that? Relationship, age, and self-support, and home. That's your RASH, right? Okay, relationship. The dependent is related to the taxpayer. Again, has to be related by blood. Again, cousins do not count in terms of relationships. Keep that in mind. And then in terms of age, the age is under 19 or under 24 and a full-time student. So again, if they're between 19 and 23, they have to be a full-time student. The other test, self-support, the taxpayer does not support, the dependent does not support himself or herself. Specific rule is more than 50%. But again, as long as the dependent does not provide more than 50% of support, and the other tests are met, they're okay. Then home test, dependent has to live with the taxpayer. There's some temporary absences tests that apply. And here, military would be a temporary absence. They don't have to live there. If the dependent's in college, that's a temporary absence. They're away on campus at a different state or a different city. Again, that would be under temporary absence. That would be an exception to that rule. The qualifying relative, first test is gross income has to be less than the exemption amount. Taxpayer provides more than 50% of the dependent. And then the last one, the dependent is related to the taxpayer. Again, cousins do not count. Or the dependent live with the taxpayer for the whole year. So you can claim your significant other is, as long as your significant other has income less than 4,300, you're providing more than 50% of your significant other's support, and they live with you for the whole year. You can even claim a freeloading friend as long as their gross income is less than whatever the exemption amount is that year, 4,300. As long as you're supporting them more than 50%, as long as they live with you for the whole year. Same thing with cousins. Again, cousins are not considered related to you. Cousins, as long as their income is under the 4,300, you provided more than 50% support, and then again, they have to live with you for the whole year. I added the next section because I was debating if I should include this or not, because personal dependency exemptions are suspended in a way. So why do they even give numbers there? So you may actually see the textbook does give 2019 and 2020 exemptions. So I just put the exemption amount for 2020, which is 4,300. So it is applicable here. Like if you look at the qualifying relative test, well, we're applying the 4,300 in this circumstance. So even though you're not using it to compute the taxpayer's taxable income, you are using that amount in other provisions of the Internal Revenue Code. Like in this case, I'm trying to see if this person is a qualifying relative. And that's even going to be more detail. If it is a qualifying relative, then other benefits qualify. Even though I don't claim that person as an exemption. Even though I don't get this exemption anymore, 4,300, I still use this as a threshold in applying in it for different tests, different provisions on the different sections of the Internal Revenue Code. And here's one of them, qualifying relative. Here's another one as well. This is another way you would apply for it. These are the benefits that went up. Tax Cuts and Jobs Act doubled the child tax credit. Child tax credit used to be $1,000 for each child under the age of 17. You get $2,000. It used to be 1,000, but again, it doubled as part of the benefits. Uh, Same thing as qualifying child tests, except key takeaway: the child has to be under 17. Another requirement that I add here is that taxpayer or the dependent has to have a social security number. If the dependent has an individual taxpayer identification number, what's known as an ITIN, they cannot get the child tax credit. Again, they cannot get the child tax credit. Uh, they can get possibly another credit, but not the child tax credit. So just keep that in mind. So that's the child tax credit. There's another credit available. There's a $500 credit available for what's called a credit for other dependent or dependent tax credit. Now this, it goes back to qualifying child and qualifying relative test. So I sort of just copied and pasted, slightly over here. Qualifying child test. So this is sort of how it works. If you have a child, this is your child, and that person is 17 and older. Let's say 17, 18, 19, 20, 21, 22, 23, and they're your dependent. You can't get this $2,000 tax credit because they're not under 17, but they qualify as your child under the qualifying child test, relationship, age, self-support test, and home test. Again, you go back to these tests. These tests are still applicable. So you don't get the $2,000 credit there. Again, your kid is 17, your kid is 18, your kid is 19. Again, they're still your qualifying child, but they're not under 17. They're 17, 18, 19, they're 17 and older. You don't get the $2,000 credit. Well, you get the $500 credit. So what I just told you, this is it right here. The relationship test is met. The age test, and this is between 17 to 23. Self-support test still applies. The home test still applies. So that's one way of making it work. But what if they're not a full-time student? Or in that circumstance, they're not under 24. They're 25, 26, 27, and so forth. Maybe it's your significant other that you want to see that if you can get the benefit from. Maybe it's your parents. Well, your parents can't qualify as qualifying child, right? Or your significant other won't qualify as a qualifying child. Well, maybe in some cases it can, but generally speaking, it can't. What about qualifying relative test? Qualifying relative test is still applicable here. Gross income test is less than the exemption amount. Taxpayer provides more than 50%, and the dependent is related to the taxpayer, or the dependent live with the taxpayer the whole year. So this is where you have your kids that are older. Again, they're 25 or not a full-time student. You can still claim as on the qualifying relative test, and that's $500 credit. Or a dependent, like your parent, you can still get that $500 credit because they will meet these tests, or a significant other will meet these tests. Now, with this particular option, again, this is a taxpayer can have either a social security number or an ITIN. Either one works for the dependent tax credit. One thing that I forgot to mention, and I forgot to type here, in terms of this specific rule. Now, with the dependent tax credit and the tax credit, one thing I want you to think about is that the Tax Cuts and Jobs Act was just more than just a tax reform bill. It had other provisions in there. It had some elements of immigration reform in there. It had some elements of healthcare reform in there. And I'll tell you a little bit about that, as we progress in class. But in terms of the immigration reform, this is how they added this particular language in here. In order to get either the child tax credit or the dependent tax credit, that dependent has to live in the United States for 12 months. Again, this is part of the Tax Cuts and Jobs Act. In order to qualify for the child tax credit or the dependent tax credit, that dependent has to live in the United States for 12 months. So what happens, I'm sure you probably heard before, some of you may have heard, I know people that do this. Let's say they're sending money back home to Mexico or to Canada, and they're going to apply for an I-10 and try to claim them as an exemption. Under old tax law, so long as the rules are met, again, qualifying relative tests are met, so long as that met, you can claim the exemption. As long as they lived in the United States, Canada, or Mexico. That was under NAFTA, and that was applicable for several years. As part of the Tax Cuts and Jobs Act, that's no longer applicable. That person has to live, in order to claim any type of tax benefit, they have to live in the United States. So you see where the element of immigration reform entered the picture of the Tax Cuts and Jobs Act? It's in there. It's part of the tax law. It's part of law. If you agree with it or not, it's still the tax law. So what you're probably seeing right now, you can't really get I-10s or apply for an I-10 for a dependent that lives in Mexico, but you can still ask for an I-10 for a spouse that lives in Mexico. So it's a bit different in terms of the procedure matter. All right, let's talk about kiddie tax. What is kiddie tax? Kidding tax. I was typing this up and I saw. You guys see the mistake I made? Kiddie tax. Okay. All right, I don't make mistakes. Okay, I do make mistakes sometimes. See, I only did that to see if you guys were paying attention, and nobody caught that. So here's how the kiddie tax works. This is just to give you a general idea what some people try to do, and they always thought this was a good way of tax planning. I have a lot of money. I'm the parent. I have a lot of money. I'm going to put it in my kid's account and have it be taxed on their tax bracket. It doesn't work that way. So this is how the kiddie tax works. It is more specific. The tax itself is more specific on how the income is going to be taxed. It's actually going to be taxed at the parent's return. But this is how it's broken down to. A kid is defined as a qualifying child, again, under 19 or under 24 and a full-time student. But that person has unearned income, again, dividends, interest, capital gains, royalties, rents. Again, that's what's considered portfolio income. That's unearned income. If it's between 0 to 1,100, the tax rate is 0. You guys remember the standard deduction, the starting standard deduction for a dependent? If you go back all the way on top, we're right here, 1,100, right? So remember that number. That's a basic standard deduction for a dependent. So up to 1,100 is tax-free. I guess the same thing can be said over here if you're single. Up to 12,400, it's tax-free. Same thing for dependents. So up to 1,100 is tax-free. So this is how it works. So the first 1,100 of unearned income is not taxable. So what about if it's over 1,100, but under 2,200? And that's going to be the taxpayer or the dependent's tax rate. That's the 10%, the lowest tax bracket. It's going to be taxed at the 10%. Here's where the kiddie tax comes in. Once the unearned income, again, interest, dividends, capital gains, is over 2,200, then it's taxed at the parent's tax rate. So people that try to be creative and try to put money into their kids' accounts, that's fine and all. They're still subject to the kiddie tax, and it's still going to be paid on the parents. It's not going to be paid on the. I mean, it is going to be paid on the parents' tax rate. So that's how it's going to be applied. So just keep that in mind. There's really no way of cheating the government. Well, there is. You can find positions that favor your client. You can find positions that favor whatever you're trying to support. There are a lot of deductions available. Okay, quick overview. Let's do a polling question real quick. So I started adding these polling questions. Let me see. Wait, no, that's not how I want. Wait, can you guys see the questions? There's too many questions. I thought
I can see it.
Yeah, that's I'm sorry. Never mind. Scratch that. Well, actually, let's just go over one of the questions real quick. We'll go over the first two questions just if you think about it. I entered them all at once instead of entering them individually. I wonder if I can split them. But anyway, let's go over the first two questions. Which of the following is not considered primary source of tax law? What do you guys think? There's something from that list is not considered primary. I guess you could answer it from your end. Just do the first two.
IRS pubs.
You guys agree with that, IRS publications? Okay, good. Again, Internal Revenue Code, that's statutory, Treasury regulations, administrative, U.S. District Court, judicial, so IRS publications, yes, that would be one. Next question. If I sell my personal residence at a gain, do I have to report it as taxable income? There's three options, yes, no, it depends. What do you guys think? It depends.
It depends.
It depends. It depends. Yeah, it really depends. It really depends. All right, I think somebody had a question. Do you guys have any questions? You can ask me now. Let's do a quick wait, chat.
I had a question earlier that I wrote for these, like, for all these tests about dependence. Does every item have to be met in order?
Yes.
Okay.
Yes.
So
yes.
if one of them doesn't meet, if you don't meet one of them, it doesn't count.
It doesn't count. Correct.
Okay, that's good. Thanks.
Yeah. Good question. So again, going back on the dependence tests, you got to apply all tests. So I guess just to give you a scenario, so let's go over the qualifying child test. The qualifying child test, my dependent, well, I'm trying to analyze something for my dependent who's let's say 20 and not a full-time student. She's a part-time student. Well, she's related to the taxpayer, so that test is met. The self-support test is met. She's not supporting herself, and the home test is met. So the only thing that's not met is the age test, right? But that doesn't mean we can't claim him as a dependent. We can't claim him as a qualifying child. Well, now we apply the qualifying relative test. Again, going over the question on qualifying relative test. Well, again, we can't do it at qualifying child test, and nobody can as qualifying child test. And then let's do qualifying relative. Does the dependent have any taxable income? If she does, is it under the 4,300 or whatever the exemption amount is that year? Say that's yes. Does the taxpayer support the dependent more than 50%? Yes. Is the person related to the taxpayer? Then it's yes. Then in that case, it meets for qualifying relative. So the way it works, you do got to apply all tests, but you do qualifying child tests first. If that doesn't work, then you go to qualifying relative. Another takeaway that I didn't talk about this here, and I probably should have put it in there as a tiebreaker rules. So what happens in situations where more than one taxpayer claims a dependent or can claim the dependent? It actually started from, before it wasn't authoritative, and now it is. When more than one taxpayer claims a dependent, who should get the dependent? So what do you guys think there? So who should get the dependent? Well, this is the way the code is split up in terms of who should get the dependent. Well, first it goes to the custodial parent. Well, actually, let me date back. It goes to the parent first. So let's say one person is the parent trying to claim the exemption, and one person is the uncle. Well, the uncle's not going to get it. The parent is going to get it. Again, on the qualifying child test. What if the parent doesn't have any taxable income, but technically it's still the parent's dependent? Nobody else, qualifies. That's usually how it works. So in that circumstance, again, you have to apply the qualifying child test first. Tiebreaker first parent. So let's say they're both the parents. Again, first test is the parent. Then if they're both the parents, what do you think happens there? Custodial parent. So again, first test is whoever the parent is. Second test is who's the custodial parent. And again, that's usually in a divorce decree. It's stated in there who's the custodial parent, or separation agreement, or maybe not. Maybe it isn't stated in a legal instrument. Let's say it's actually just by facts and circumstances. Then you actually just measure the days. Who did the dependent live with the longest, the more number of days? Most of the time it should be one parent and not the other, but that's not always the case. Sometimes it could be even. Let's say it was even. So both parents can claim them. There's no custodial parent because the dependent live with each parent, an even amount of days. That can happen. Who gets it then? The person with the highest adjusted gross income. Again, that's tax law. That's the way it works. First is the parent. Whoever the parent is entitled to claim the dependent. Then it goes to the custodial parent, and then it goes to the person with the highest adjusted gross income. these are known as the tiebreaker rules. Again, before what that came about, it came about a lot of cases that went to got audited and was issued in a notice before, and it took a while for it to actually be codified in the actual code. But that's how it works for claiming somebody as a dependent. All right, let's talk a little bit about itemized deduction. Go ahead. Yeah. You use the old rules that are applicable for that year. And one of the that's actually a good question. So so for 2018, 2019, we're using the Tax Cuts and Jobs Act. That's the law. For 2017, 2016, we're using pre-Tax Cuts and Jobs Act. You want to know what the different rules are? There's none. Over here, dependency rules. Dependency rules haven't changed, actually. It's just the application of these rules. Again, the dependency rules have not changed. They're still qualifying child, qualifying relative. Those rules have been there since 2004. 2004 is when they bifurcated the two dependency tests. Prior to that, these rules were combined. Gross income applied here, except when you don't, except when it's a full-time student. 50% test was there, and it was all over the place. So what they did in 2004, they bifurcated it and formed the qualifying child test, which is what you see there, and the qualifying relative test, which is what you see there. That still applies. The only number that changes each year is the 4,300. So each year you're going to have to find that exemption amount. And again, and actually, I'm glad that you asked me that question. So now, how do you figure out this? Then you're going to use this formula to figure out taxable income, right? Gross income, here's where the difference. You do apply personal exemptions. And filing statuses are still the same. But in terms of the standard deduction, just to give you an idea, for 2017, the standard deduction for single was about 6,000, 6,300 to be exact. But the reason why they said that, as part of the Tax Cuts and Jobs Act, it doubled. Well, not necessarily. It didn't exactly double. It approximately doubled. It wasn't, doubled, but it did practically double. So the way I compare it, prior to Tax Cuts and Jobs Act is $6,000. After Tax Cuts and Jobs Act, $12,000. So it did double. Same thing for all the other filing status. Had a household prior to Tax Cuts and Jobs Act, $9,000. It practically doubled under the Tax Cuts and Jobs Act. So you're applying different thresholds depending on the year. So you will have to look at it on the year. But everything else, this standard deduction, the same. However, it's 11,100 may have changed. It's probably $1,000 a couple years back, depending on how far you go back. But yeah, these rules are still the same. They're still applicable. Here's where it changes. This dependent tax credit, not available in 2017 and prior years. That's only Tax Cuts and Jobs Act. The child tax credit, the $2,000, that was $1,000 for years before 2017 and prior years. It was $1,000. So you may notice that, but the same rules apply. It's still the exact same thing here. And then also keep in mind with the Social Security number, that wasn't always a factor. But this Social Security number, that didn't come in as part of the Tax Cuts and Jobs Act. This particular provision actually came during Obama's administration. As far as having a Social Security number, yeah, it came in during Obama's administration. That's when that came in. As far as being in the United States, only in the United States, that is part of the Tax Cuts and Jobs Act. Now, as far as analyzing dependents, can they claim a dependent in 2017 in Mexico? Yes, right? Because that's not a requirement to live in. It's a requirement to live in the United States, Canada, or Mexico. So long as the gross income test is met, you provide more than 50% of support, and that person is related to you. So you could claim a dependent that lives in Canada. Again, Canada, United States, and Mexico. So again, 2017 and prior years, that's still applicable. But for 2018 through 2025, that person has to be in the United States for 12 months. So that's specific, and in terms of that specific, yes, that has to be applicable in that year, in 2018. that rule is not applicable in prior years. So don't apply that rule in prior years. So they can, I guess, say going with that, I guess you could get an I-10 for somebody if you date back prior years. Only the process, it would be long, the process to get an I-10 for like a 2017 tax return or 2016 tax return. They usually do a preference to more current ones first. Yeah, that was a good question. Again, apply the tax line, not just for dependents, that goes with anything. Apply to whatever is relevant in that particular tax year. But a lot of it, you're going to find out it's pretty much the same. The numbers just change. Let's do an overview of itemized deductions. Again, even though we're not going to go over itemized deductions up until like after the midterm, we are going to talk about these over and over and over. Once we reach the midterm, this is just going to be like secondhand nature. That's just we're going to get into specific medical expenses. Can we deduct? What taxes? At that point, you would already have an idea what can we deduct, charity and so forth. And in terms of gambling losses, that's the only thing that can be deducted. Expenses subject to the 2% AGI floor. That's what's been temporarily suspended. Again, 2018 to 2025. These are the current dates. These include employee business expenses, production of income expenses, hobby expenses, job hunting expenses, tax preparation fees, investment consulting advice. That section that used to be 2% AGI deductions, that's not there anymore. And a lot of taxpayers are actually going to not claim a deduction. And this is actually even relevant even nowadays, considering what's happening with the coronavirus. Think about what's happening nowadays with the coronavirus. A lot of people are working from home, right? Can a home office be deductible? Well, it depends. For an employee, probably not. I'll tell you why in a few minutes. What about if somebody's self-employed? Well, somebody's self-employed, perhaps, so long as they have a separate room that's exclusively used for business. Again, it doesn't have to be a separate room. It has to at least be partitioned. It has to be sectioned off. As long as that particular section is used exclusively for business, then it's deductible. Let's say you're working from your living room. The living room is not exclusively used for business. What if you're working from your kitchen table? That's not exclusively used for business. Let's say you're working out of your bedroom, not exclusively used for business. Again, that section of your home has to be exclusively used for business. Now, in terms of the difference between self-employed individuals, they get a deduction for AGI. What about employees? A lot of employees are working from home nowadays. What happened to the employee business expenses? They're gone. That's part of this whole section. So can you take a deduction from home office expenses? No, you can't. So if somebody tells you, even though you're working from home, you can benefit from taking a home deduction, that's not true. It's not true at all anymore. Congress has not addressed this, and maybe they will, maybe they won't. Maybe they'll give temporary relief for that, but it hasn't been addressed at all. So right now, employees cannot deduct the home office expenses because that whole line item has been eliminated, including home offices. Next section, I just want to give an overview of property transactions. I actually have two pages. Again, I modified this. The second page, I want you to review on your own. The first page, that's where we're going to just do a quick overview. Again, this is still part of Chapter 3. I want you to at least understand these concepts. In terms of property transactions, there's 3 questions that you're going to ask in terms of what happens, what are the tax consequences. First question is, what is a realized gain or loss? Just to put it in simplest terms, this is the difference between your selling price and the cost basis. That's it. Again, the difference between your selling price and your cost basis, that's your computed gain or your computed loss. Question number 2, what is your recognized gain or loss? So that's what gets reported on the tax return. Recognized gain is whatever gets reported on your tax return. And then the third question is, so of that gain that gets recognized or that loss that gets recognized, what is the character? What is the character? That character is actually discussed in more detail later. It's actually split into 2 character issues. It's either ordinary income or capital gain. But even with that, it gets into more detail. Somebody please put your mic on mute. Thank you. Again, we talk about 2 characters. There's ordinary income again, what that means is the income is taxed at whatever the ordinary tax rate is for the taxpayer. So let's say he's at the 25% tax bracket or 32% tax bracket, then that income is going to be taxed at the ordinary rates. That's what ordinary rates mean. And then you have capital gains. Capital gains means it's going to be taxed at a lower rate, 15%, 0%, or in some cases, 20%. So you got to know the holding periods first. Short term, 1 year or less. More than a year, again, I repeat, more than a year is considered long term. So the long-term capital gain tax rates kick in when you hold an asset long-term. That's why people always say, hold it long-term more than a year. More than a year, always hold it more than a year. That way the preferential tax rates kick in. Over here, I just gave you a quick overview of the basis. What's the basis? What's my cost basis? It's whatever you paid for it, minus accumulated depreciation and so forth, which that's covered in more detail later. But what if you receive something as a gift? The general rule is whatever the donor, the person that that's giving you the gift, is his or her basis, generally speaking. What about if you receive something as an inherited property? Then it's going to be the fair market value at date of death, generally speaking. So again, even if you don't pay for it, you do have some basis, either because you received it as a gift, it's a carryover basis, or you inherited the property, it's a step-up basis. So those are your basis rules. Again, quick overview on what's considered capital gains and losses. Remember, long-term capital gains are taxed at a lower rate, that's 0, 15, or 20%. 20% is for the individuals that are at the highest tax bracket. Short-term capital losses are taxed, that should be short-term capital gains. Sorry. Another error that I made. Short-term capital gains are taxed at regular rates, ordinary rates. Capital losses, either short-term or long-term, it's limited to $3,000. The most you can deduct of capital losses is $3,000. Again, let's say I sell a capital asset and I have a loss of $6,000. I can only deduct $3,000 in the current year. Well, I offset it with any income, any capital gain income first. Whatever is left over, the most I can deduct is $3,000. So again, I have a $6,000 capital loss. I only deduct $3,000 in the current year. The other $3,000 gets carried over to the next year until I use it all up. Wait. Hold on. I'll get there. Hold that question. That's exactly what I was. You just read the next note. Okay, not all assets are capital assets. You must have read my mind. Not all assets are capital assets. Can you read the next section? Was that you, Matthew? The next sentence? Or who was that? Okay. What's the next? The one that's highlighted. You guys get that? Let me repeat that. The code doesn't tell you what a capital asset is. It tells you what a capital asset isn't. That is true. So one of the things that it's actually pretty simple when you're applying the code. I'll give you an example. People, when it came to virtual currency, trading virtual currency, Bitcoin, and what's the other one? I can't even, there's a whole bunch of them. But Bitcoin is a more popular virtual currency. People were like, well, it's currency. No, it's not currency. Well, is it a capital asset? Yes, it seems pretty simple. People were saying, well, nowhere in the code does it tell you that a capital asset is. It actually does. And this is how capital assets are defined. And I gave you an oversimplified short list of this, but it's actually really as simple as this. A capital asset is not inventory, accounts receivable, or fixed asset. Again, accounts receivable, that's ordinary income. You sell a receivable or your book a receivable, then you're collected from that receivable, that's ordinary income. You sell inventory, you're selling inventory because it's your ordinary course of business, ordinary income. So inventory, accounts receivable, ordinary course of business, ordinary income. What about fixed assets? Those are your depreciable assets, your non-current operating assets. By the way, the code does not call them fixed assets. They call them depreciable assets. But because I know a lot of you are accountants or have an accounting background, you should understand what fixed assets are. So if it's not inventory, if it's not accounts receivable, if it's not a fixed asset, what is it? A capital asset. Now, what was that question you just asked me again? You just asked about A car?
Yeah, if you had to sell your car after, say, 2 years of ownership, so it would be in the long-term loss category potentially.
Ah, well, let me even take it a step further. You sell your car at a gain. How for 2 years? How is the gain treated? More specific question: what type of asset do you have? You have a capital asset, right? So you sell it at a gain. What type of gain do you have? A capital gain. And so in that case, the capital gain would be taxed at a lower rate. You sell your personal residence at a gain. What type of asset is that? A capital asset, right? So it's a capital gain. You sell stock from a corporation at a gain. What do you have there? A capital gain. You sell partnership interests at a gain. And same, you guys see the exercise that I'm doing. As long as it's not inventory, as long as it's not accounts receivable, as long as it's not a fixed asset, so it works by exclusion. It's a capital asset. So the code doesn't tell you what a capital asset is, it tells you what a capital asset isn't. That is so true. And I really want you to memorize that. So what is a virtual currency? Virtual currency is not inventory, it's not accounts receivable, it's not a fixed asset. So when you sell or trade virtual currency, you have a capital asset, you have a capital gain or a capital loss, right? And it seems very simple to determine what a capital asset is. Now, before we get any further, again, here's like a quick overview of more detail, the stuff we're going to go over in terms of what recognized gain and so forth. This is the section that I want to, think about in more detail. Remember, I told you that it's usually just ordinary and capital, but when it comes to the types of assets, it's actually split into 3 different categories. We have your ordinary income assets, again, inventory and receivables. Your fixed assets. Remember, I told you the code doesn't tell you that it's a fixed asset, but it does give you a section 1231. Section 1231 pertains to fixed assets. So when you sell a fixed asset at a gain, you do not have capital gain. Again, you sell a depreciable fixed asset at a gain, you do not have capital gain. Now, so you probably heard different. Well, you heard different is actually not true. You may have a 1231 gain, but you don't have a capital gain. That's covered in more detail and in more detail later. What's 1231 gain? Just to tell you, 1231 gains can be capital depending on the circumstances. But even when it comes to depreciation, the depreciation itself, you have to account for that a certain way. If you're claiming depreciation, that's going to be taxed differently. So when you sell a fixed asset, some of it is capital, some of it is ordinary. So it's actually a whole different animal. Just know this. I'm not trying to confuse you. All that I'm saying is a fixed asset is not a capital asset. It is not a capital asset. It's a 1231 asset. Special rules apply to 1231 asset. Don't automatically think that it's a capital gain. One of the questions that I get a lot is, I'm selling my rental property that I use for business, that I'm renting. What's my capital gain? Is that a simple question? No, it's not. You have a 1231 asset. So that's subject to several rules. You got to treat the depreciation that you claim differently. That's taxed at a different level. And then whatever 1231 gain, that's taxed at a different level. So it's very, very complicated. Not all of it is capital. Maybe none of it is capital. It's just a 1231 asset. So again, ordinary income asset, fixed asset, which is a 1231 asset. And what's a capital asset? If it's not 1 or 2, then you have a capital asset. That's generally how it works. Now, to your question, you're actually getting a bit ahead of yourself, but that's actually a good question. So I sell my car at a gain, that's income. What happens if I sell it at a loss? Can I deduct the loss? Well, first question is, what type of asset do I have? Capital asset. What type of loss do I have? Capital loss. Well, can I deduct that? What do you guys think? What do you think, Matthew?
I don't think you could deduct it under the capital loss rules because aren't cars usually fixed assets?
No, a car is not a fixed asset.
Or a wasting asset or something?
A what?
I don't know. I read something about wasting assets when I was trying to look up stuff on this.
I don't think that's an accounting term. I don't think that's even a tax term. Why is a car a fixed asset?
Keep it for longer than a year
That's no, that's
No.
not a fixed asset.
and use
What
it.
is the definition of a fixed asset? A depreciable asset that you use in operations.
Right.
Let me tell you again. You're using it in operations. You're depreciating it. Are you using your car for personal purposes or for business?
In this case, it would be for personal.
Then it's not a fixed asset.
Okay, so it's
Okay,
the
think about
business.
this. Are you depreciating something that you're not using in business? No, you're not. Then it's not a fixed asset. So then it's considered a capital asset. So you can't deduct it at all, actually. When you sell a personal use asset, and I'm going to say this several times, when you sell a personal use asset, any personal use asset, there's no deduction available. So if you sell your house, your personal residence at a loss, you can't deduct it. You sell your car at a loss, you can't deduct it at all. It's still considered a capital asset. Keep that in mind. It's still considered a capital asset by these rules.
Mhm.
Still considered a capital asset. But how come you're not able to deduct the loss? That's a personal loss. You cannot deduct that as a loss. And there's several code sections. So the one that I'm going to just give you is section 262 that does not allow any personal expenses as a deduction. Starting next, well, actually in a couple of sessions. So next week we're going to start talking about tax deductions, and that's actually something to think about. But again, it's you gotta first ask yourself what type of asset it is. You're gonna ask yourself, can you take a deduction? And when it comes to deduction, there's a whole different issues altogether. Again, this is not going to be a deductible expense under Section 262, personal expenses, not deductible. Now, again, Section 262, since we're on that topic, is a pretty common section. But you're probably thinking, well, that's not true. I heard that there's personal expenses that are allowed. Again, this is the way the code actually works. There's going to be a governing section anywhere, and this is it. This is law, unless there's a provision that tells you otherwise. So here's the law. Section 262 is you cannot deduct any personal expenses, but that's not all, except if there's a law that allows you to take personal expenses, right? So what are personal expenses that are allowed? Well, let's go over this list real quickly. Over here, this list of personal expenses that are allowed. That's because these sections are governed in other provisions, not Section 262. Again, Section 63D talks about itemized deduction, and then other provisions talk about specifically all these itemized deductions. So again, these are still allowed. So again, Section 262 has been around for years. Again, means you cannot deduct any personal expenses except when they are allowed. So keep that in mind. That's how usually the code works in a way. I'm going to give you another code section that's very, very popular, Section 61. Section 61 of the Internal Revenue Code. Again, Section 61 of the Internal Revenue Code tells you everything is considered gross income unless there's provision that tells you otherwise. So does that mean you got to report all your income? Yes. But what if you have interest from a municipal bond, a state and local bond? Well, state and local bond, that's specifically excluded by the code. That's not income. What if I receive something as an inheritance? That's specifically excluded by the code. It's not income. So again, that's how you're going to see the code. There's always going to be this overall provision, meaning everything is considered income in Section 61, or Section 262, meaning there's no deduction. But look for those exceptions. Again, this is where your research comes in. It's good that you started thinking about, well, what are your exceptions? But you gotta, navigate through, the code, to understand how to find the best sections to help your clients. So yeah, I guess unfortunately you won't be able to take that loss on selling your what were you selling, your car? Let me change the facts a little. Let's say you did not have a car. Let's say you had a yacht. I don't know if you have a yacht or a boat or anything, but let's say you had a boat by the lakefront. You're meeting clients. You do meet clients on occasionally. Now, what type of asset do you have there? Are you using that asset in operation? I would make an argument, well, you are meeting clients and you may be renting it here and there, so you're using it in operation. Is it a fixed asset in that case?
Yeah.
Yeah, then in that case, it could be a fixed asset, right? Then you may be able to deduct the loss. In that case, it all depends because it's a different. It's not a personal use asset
And I should be taking depreciation deductions as
because you're using it in business. You're using it for business, so yeah, you should be taking depreciation for that. That's a good question.
In that case, there would be no allocation for business versus personal. It would be all business or all personal.
No, it depends. No, it's never that simple. I guess with that, you just make your best judgment to tell your client. Be reasonable. This is what I tell my clients. Let's say something that's very common. I know a lot of my clients use their cell phones for business. I use my cell phone for business purposes. I probably pretty much close to 100% use it for business, and I think a lot of people do use it for 100% for business. Well, not all. There's some that don't. Let's say you don't make a lot of phone calls. It's mixed, 50-50. Ask your clients, always ask your clients, be reasonable. What would be a reasonable way to allocate it? Is it 50-50, 60-40, and so forth? I would also do it in this circumstance. And also the same thing, what's the intent of the asset? If they're buying it to entertain clients, then yeah, your argument can be it's pretty much 100% used for business. So just keep that in mind. Entertainment expenses, on the other hand, well, there may be limitations on the on entertainment expenses. That's not deductible anymore. So just keep that in mind. You may still be able to depreciate it, but in terms of the entertainment itself, then the entertainment is not deductible at all. That's part of the Tax Cuts and Jobs Act. So there's still depreciation and other expenses, but not entertainment. So if you think about it, you're treating it like a business. You have utilities. You have maintenance there. You have storage, dock fees there. All that's it should be deductible so long as there's a business purpose. So just keep that in mind. All right, I want to share the IRS website real quick. Again, I want to show you how to do research the old-fashioned way. This is the IRS website. Some of you may be familiar with this. Some of you have seen it before. How do you get your transcripts, make a payment? I'm sure some of you went through KIDMAI Economic Impact Payment, stimulus payment. Very useful. It's very useful. A lot of resources here. But over here, if you look in the upper right, there's a Tax Pro section. You guys see it? Tax Pro on top. Well, there's different ways to navigate it, but if you see Tax Pros on top, it gives you different accesses here. The P10, that's if you have a tax preparer, prepare a taxpayer identification number, not the I-10. This is if you're doing taxes. You can. That reminds me, I gotta renew mine. This is where you register and renew it. E-services, something else. This is a good service to do. It's IRS service. You can look up transcripts. You can communicate with the IRS on a limited basis. A very good tool to have. Other information here, on the bottom and so forth. Again, pretty user friendly, right? Practitioner priority numbers in there. A lot of good information is in there. Actually, they changed it a bit. They used to have a link that has research. They changed it. Let me just click research. They updated this website. So it used to be under Tax Pros, but I don't see it. There was a section that had research. So just click in research, legal guidance. Oh, it's not there anymore. Yeah, this used to be right on the professional page. Maybe it's not available anymore. I don't think it's available at the IRS website anymore. I'll tell you where you can go. What would happen if you go to the Internal Revenue Service? If you look up the code, eventually it will take you to the Internal Revenue Code in the Law School of Cornell, and that's free. It's updated, very frequently. Again, just Google Internal Revenue Code, and you'll find it. Again, if you go to the IRS website, there should be a way to go directly from the IRS website. Then it takes you, here. By the way, it's Title 26 is the Internal Revenue Code. Again, Title 26 is the Internal Revenue Code, and it's broken down into different, sections and so forth. What we're going to talk about in this class, it's, Subtitle A. Subtitle A has, different sections and so forth. Again, this is the old way of sort of researching. Again, you sort of, there's, again, if you go to the IRS website, you can just type in the code section and then take you specific to the code section. Over here, you're doing, if you think about it, this is how you would do research the old-fashioned way. You go, you would go to the outline and then go into more detail. Let's say I want to ask a question on if something's considered gross income. Well, I know that's section 61 because, your teacher told you that's gross income. So I started looking at code section 61. Now, there is some exclusions available. The exclusion, we're going to talk about that in more detail in next section, actually. Here's where your exclusions come in. Again, section 61 tells you everything's included. Here's all your exclusions. So all these exclusions are available. So let's say I'm selling my personal residence as an exclusion. I know that's somewhere in one of these sections, but more specifically is section 121. So I click on section 121. And now I go do my research. I start reading and so forth. I look at my requirements. I can exclude up to 500,000 or 250, but I have to live in the house for 2 out of the last 5 years. And here's where I talk about the rules and so forth. You got to do a lot of reading. The other way of doing it is if you use the IRA Checkpoint Research Library. And let me see if I can show you real quick through my way. That actually has keyword searches. You guys see the way we did it is pretty time consuming, right? Let me show you how I would do it. This is what I like to use, the text research library, the IRA Checkpoint. Some of you who have the textbook should have this. If you have the edition that has a 6-month subscription, it tells you how to log in and how to access this. This is, I guess, text research on steroids. I like this a lot. It's very, very, good way to do research. Think of this as Google keyword searches. So it's driven by keyword searches. I go straight to, you can do some research here, straight to the code section. I'm going to go straight to Checkpoint. Let's see, search. Yeah, you got to bear with me. It's a little slow right now. Now, again, over here, you want, highlight. Here's the primary sources. Now, one thing, IRS is not primary. They just grouped it in primary. It's not, IRS is not considered a primary source. But the reason why that's considered primary source, because it is good to use in guidance. And then over here, I don't want any articles. I just want to look at the code section. Handbook, textbook, the master tax guide is there. Let's say personal residence. So let's say I want to see personal residence, right? Again, just the way you do, you see how it populates what it starts thinking, similar to Google. Okay, I found a couple sections in the textbook, in the handbook, the guide. Well, it gave me the code sections. If I look at the code, you guys see how quickly I got to my answers? Okay, here's a couple sections here that refers to personal residence. Well, I'm still not there. Again, here's gain exclusion, maybe that. And you guys see how specific that is. It's very efficient. Again, it gives you different cases, regulations. Here's a couple cases. If I want to look at the cases and so forth, this is where I do my research. Which would you rather have? Would you rather have this or are you doing it the old-fashioned way? What do you guys think? Honestly, I prefer doing it this way. Again, to the extent that, it's again very, very good to do it this way because it, goes straight to the answer. But you have resources. You have the textbook available. That's where you can start with the textbook. There's a tax guide available. There's all kinds of resources available where you can start with your secondary sources and then look at the code section. Again, I like doing it this way because it's very I guess efficient. Is there any tax question that you guys want answered? Any questions? Anything? How about cannabis taxation? This is going to be very interesting. I want to see how much. Well, I know what section is going to populate. ADE in there as a code section, and then there's several cases as well. So again, there's a lot of cases in here as well. So probably too many. Nothing else you want to ask? No research, any questions you want to ask? No, nothing. Again, this one also works by citation. It goes straight to the citation. Again, I want to look at section 61. Actually, let me go to the code that I was looking up right now, section 280 capital E. So drug dealers cannot deduct what? Expenditures in connection with legal activities are not deductible. So here's a code section that tells you, everything is, deductible. Again, over here, that tells you the history and you can't do that if you use the Cornell Law School. You can't do a history search, but this one gives you the history. Very good history on section 280 capital E. It actually started in the 80s, the war on crimes in the 80s. It actually stemmed from a court case. Again, it does refer to doesn't say the specific law, but it was in 1982 or the specific case. But again, it does tell you the history. Let me do another one. How about section 63? Now we talked about itemized or taxable income. Here's another one that you should be familiar with, section 63. Couple key code sections that want you to be familiar. Gross income, that's section 61. Adjusted gross income, section 62. Taxable income, section 63. So here's where it talks about deduction and so forth. And one thing I want you to see, now you see how I'm hovering over, C. You see what you see there, 63C. So it gives you the section. So it gives you that option as well. And then different ways to the treatises. That's additional secondary source to look into. If you want to do secondary source into that, you can click on that as well. Again, that's pretty much it that I have for. Here's the Tax Cuts and Jobs Act provisions, 2018 to 2025. Again, that's where it double those standard deduction amounts, so forth. That's the repealment of. That's that's been repealed. I don't see exemptions on there at all. Yeah, this is where exemptions would have been, right here, number 8. So if you look at if you look at a code section prior to the Tax Cuts and Jobs Act, you should see exemptions right around here. It's not listed anymore because it's not, it's not there. All right. Any questions on research? No questions? Are you guys ready to do some problems from the textbook? Yes? All right, great. Chapter 2. Wait, chapter 2. Nothing from chapter 1, so this is starting with chapter 2. So I have some questions. I trust that you guys went over some of these questions before. As I mentioned, I'm not collecting homework assignment. I just review them, and I expect you guys to do them on your own. At this point, you should have already made an effort to acquire a textbook. So, and I'm sure some of you already went over some of these questions. So starting with question 3. So if you know the answer to this, let me know, because I don't have the answer and I don't have the solutions. So in which subchapter of the Internal Revenue Code would one find about corporate distribution? This is about corporations. About corporations. I'll give you another hint. It's not about S corporations. It's about C corporations.
C.
Subchapter C, yes, subchapter C. Subchapter C, those are the 300 code sections, the 301, several sections and 300 sections. That's your subchapter C. So it does talk about corporate distributions, corporate formations, mergers and acquisitions, and so forth. What if I was asking a question about S corporations? I have a question about S corporations. Where can I find the authoritative guidance for S corporations?
Subchapter S.
Very good. You're on a roll. Who's that? Who was that? I don't know who that was.
That was me, Margaret.
Okay, Margaret, you want to take a stab at another one? What about partnerships? This is a tricky one. Partnerships. What do you think?
Well, it should follow that it should be chapter P, but you're saying that it's tricky, so I'm not sure.
It's not chapter. Yeah, it's not a subchapter P. It's subchapter. Anybody have the answer? It's not P. It's not P, C, or K. It's subchapter K. These are the 700 sections of the Internal Revenue Code. So subchapter K does pertain to partnerships. Some people would think, well, it should be P. No, it's not subchapter P. So when it comes to entities, S for S corporation, C for C corporation, subchapter K for partnerships. Those are the main entities, but not the only provisions, just the ones that I want you to, at least think of. All right, 37. Again, I'm just going around some of these. There was a couple other questions previously that I assigned. Was it, wait. Oh, wait, yeah. These are two, yeah, let's, we did 37. Skip 39. Oh, 40, yeah, it did give you 40. All right, so this is how it works regarding note 39. So 40 and 41, those are good ones. So what's more reliable when it comes to authoritative guidance? So think of it this way, statutory. Yeah, it's usually your statutory goes first. So think of your Internal Revenue Code, the 16th Amendment. In terms of the legislative process, anything, as long as the bill becomes final, any committee reports would be included as primary source of tax law. And then you have your administrative sources. When it comes to administrative sources, your final regulations, then your temporary regulations carry more weight. So again, it's usually the code, temporary regulate, and your again, go back. Your code, then you have your final regulations. Temporary regulations do carry some weight. Then you have your other administrative sources, revenue rulings, and so forth. So how would I put this in order? C, the code section would be first, right? Code section would be first. Yes. Think about it. The code section is statutory. Remember, think of it in that and think of it in that manner. It's statutory. Statutory is your 16th Amendment, your code section, your treaties. That's always going to carry the most weight. Your code section, the Internal Revenue Code section, is always going to carry the most weight. Why? Because Congress said it is so. That's why Congress passed this. It's a code section. Now, you mentioned regulations. What are regulations actually? Regulations, that's just the department's interpretation, the Treasury Department's interpretation. They do carry weight, the same amount of weight as the code section, but keep in mind that they're saying the legislative regulations carry the same weight as the code regulations. So think about that when you see that analysis, if the legislative regulations or the final regs carry the same weight as the code reg, it's saying the code reg, the code section carries more weight. It's saying the code section, legislative regulation would be next. because again, legislative regulation would have the same weight as a code regulation, but not above the code section. Remember, the code section it's by itself. Regulation carries the same weight, but is after the code section. So it's C first, then B. After B, then I would put the interpretive regulations. Now, in terms of legislative regulations and interpretive regulations, again, the way it's done in practice, it's usually just final regs. So this is the way you're going to see code, final regs, then temporary regs. That's usually the way you're going to see it. It's going to be the code section, final regs, temporary regs. You just keep that in mind. Over here is going to be the code section, legislative regulation, interpretive regulation. Then what else are we going to see after that? Temporary regulation. So again, always think of it in that order: code section, final regs, temporary regs. And then you have your other sources: revenue rulings, private letter rulings, and then all the way at the end, proposed regulations. So here's the list. Again, code section is first, legislative regulation is next, interpretive regulation is after legislative regulation, and then you have your temporary regulation, revenue ruling, private letter ruling, and then all the way at the end, proposed regulation. Now, why do I have, well, actually, think about private letter ruling. I guess you can make an argument that private letter ruling can be last. Why would that be last? What do you guys think?
Is it specific to a case?
Yeah, it's specific to the case. So yeah, I guess an argument can be made. But even then, with the proposed regulations, don't really carry that much weight. So I would say the toss-up between all the way at the end would be not as reliable proposed regulation and private letter ruling. But again, yeah, be careful with private letter ruling. You can still cite them, but it doesn't carry any weight. So just keep that in mind. So they're all the way on the bottom: private letter ruling and proposed reg. So think about this.
Sorry, can you explain the revenue ruling? Where that falls?
Where that falls? Well, private letter ruling, that's if you think about it, that's it's when the IRS is asking for private letter rulings, multiple private letter rulings. Remember, private letter rulings are taxpayer specific. The example that I gave is, okay, I lost a lot of money. I invested money into Madoff's accounts. I'm sure you guys know who Bernie Madoff is, right?
Mm-hmm.
So I wasn't the only one that got defrauded by Bernie Madoff. Other taxpayers got defrauded. But I want to know how I'm going to treat my losses. So I'm going to ask the IRS for a ruling specific to my case. I'm going to pay them the fee. Then they're going to write back to me and say, you taxpayer, so long as your facts are A, B, and C, this is how you're going to treat your loss, specific to me. Okay, so what happened in that particular case? Bernie Madoff defrauded a lot of people. So what do you think the IRS received a lot of private letter ruling requests? Same fact patterns. So what they did in that case, and similar cases, they broadened the scope. Now we're going to issue a revenue ruling because it's going to apply to more than one taxpayer, so long as it follows the same facts and circumstances according to this revenue ruling. So a revenue ruling is broader in scope, so long as it meets those facts patterns. So it does carry weight. Again, the difference between that and a private letter ruling, taxpayer specific, revenue ruling, it's broader in scope, but it's still specific to the facts and circumstances. And again, all the way at the end, proposed regulation, which don't really carry much weight. Again, proposed regulations and private letter rulings are towards the end. Any other questions on question 40? Again, what I want you to take away from this code section first, so 16th Amendment code section first, and then after the code section, then that's when you're going to look at final regulations. And then you look at temporary regulations. And then the other sources that you're going to look at would be revenue rulings, and then you're going to look at I guess you could look at private letter rulings as well. What's not listed here? Judicial, case law is not listed in here. Case law does carry weight as well. That's going to be more reliable in that circumstance. Next set of facts. Now with 41, in this particular section, I want you to help me identify if it's primary, secondary. If it's primary, tell me if it's under legislative, or again, that's your statutory sources, administrative, judicial. Again, if it's secondary, it's just secondary. By the way, it can never be both. It can never be primary or secondary. It could be neither in some cases, but it cannot be both. So it's either primary, then tell me what it is, specific primary, and then secondary. First one, I'll do the first one. The 16th Amendment of the Constitution. That's primary. Statutory, right? Statutory. So it's primary, that's in the statutory, the legislative group. Next section. Tax treaty between the United States and India. Who wants to give an answer for that one? It's a tax treaty that was passed by Congress. What do you guys think? Think about it. It was passed by Congress. So it is
Primary.
it is primary. What group of primary? Yeah, statutory. Well, again, it's passed by Congress, it's statutory. Revenue procedure. Is that primary or secondary?
Primary.
Primary. What category of primary?
Statutory?
Not statutory. That's
Oh.
administrative. Again, under statutory, you're only going to have your code section, the 16th Amendment, and tax treaties. That's it. That's on the statutory. Everything else is either administrative or judicial. So that would be administrative. Letter D, the IRS publication. This one I have given you as an answer. What do you guys think? That's secondary source, right?
Yeah, it's secondary.
Yeah, secondary. Good. Letter E, the U.S. District Court decision. What do you guys think?
Primary?
Primary.
Primary? Judicial. Common sense, judicial, right?
Yeah.
An article, the Yale Law School Journal. So this is professional journal, secondary source. Temporary regulations. This is what? Primary, right? Administrative. So that's still administrative. Again, even though they're supposed to be only valid for 3 years, they're actually valid more. There's still even some older temporary regulations that are still in existence that are, but if it's within the last few years, it's only usually valid for 3 years, then it does become final usually. U.S. court decision. U.S. tax court decision. I'm eliminating one word. U.S. tax court decision. What is it?
Primary, judicial.
Primary?
Yeah, primary, and that's judicial. All right, letter I. This is a tricky one. This is a small case division of the U.S. tax court. I sort of gave you this scenario earlier. This is when they do settlements.
That's neither.
Yeah, that would be neither, because you can't cite it. Again, you can't really cite it. Yeah, that would be neither. You can't really use it as a guidance at all. That's what the purpose of secondary source. Primary source, that carries more weight. So yeah, neither. I would not use it as a source at all. Letter J, House Ways and Means Committee report, assuming the bill became final. It was voted through the House and the Senate.
Primary?
Primary.
And that would be legislative,
Just-
right? That would be legislative. So that's 40, 51. There's a question I want to do here. Let's do this question 43 next week. This deals with tax evasion, and I don't think we'll get a chance to do it this week. I want to do this is tax evasion, tax avoidance. Read that on your own along with the other problems. I want to do something with chapter 3. So the questions I want you to look at, there are other questions, but I'm going to highlight the questions that I wanted to do today. For chapter 3, I wanted to do at least 27, 28, which that's part of the list in there, 30 and 32. So here's the one that I wanted to do today, but I'm not going to get to that today. So 27, 28, 30, and 32. Now for 27, just want to walk you through 27. This deals with, computing the income tax. The taxable income. We'll walk through this next. Well, I'll walk you through it, and I want you to, work on this at home. But I am gonna, walk you through, thinking, part of it. So over here, Drew and Meg, they're married. They file a joint return. I guess you could sort of do the math here. And then in terms, you're gonna take away their AGI is 125,000. Itemized deduction is 27,000. Standard deduction for 2019. Well, again, the 2019 standard deduction was 12,400, right? So what are we gonna take here? The standard deduction for married filing jointly was 12,400. Itemized deduction is 27,000. What are we going to take here?
Itemized, it's a lot larger.
Itemized deduction, right? We're going to take the itemized deduction. You guys see that, right? Again, standard deduction is 24,400 for married filing jointly. So we're going to take the itemized deduction. All right, this one, Sybil. Sybil supports her parents and that live in a nursing home. Head of household filing status, right? What's the head of household filing status standard deduction? I think it's like 18,000 and change, right? It's something like 18,000 and change, right? Something like that. Itemized, yeah, I don't know exact amount. 18,350, I think, is the amount, or 650, something like that. 18,000 something. Itemized deduction is 8,000. Which one are we going to take? Standard deduction, right? All right, next one. Surviving spouse. On these facts alone, again, first year married filing jointly, then the next 2 years surviving spouse. It's going to be the same standard deduction as married filing jointly, at the 24,400. Itemized deductions over here is 10,100, right? What are we going to take? Standard. Again, I hope you guys are taking notes. This is how I want you to start thinking of it. Difference between standard deduction and itemized deduction. I think all of them are going to take the standard deduction, and this one had a household standard deduction, right? Itemized deduction of 10,650. Standard deduction is 18,000. All of them are going to take the standard deduction. It looks like, right? Well, except for the first one. Takeaways from that. How come in all these fact patterns, it looks like the only one we take the itemized deduction is this one? Yeah. It's sort of the point. It's limiting people, it's less people to itemize. More people are taking the standard deduction. So I guess in that respect, that is the point. People are claiming a higher standard deduction, but people are not claiming the itemized deduction. One takeaway from that, just think about the other, side of it. So is there a benefit from real estate taxes, mortgage interest, and charity? No, not necessarily. So that tax benefit is not really there available for all taxpayers. So just keep that in mind. So that benefit is not available for the taxpayers. How are real estate brokers, mortgage lenders, non-for-profits going to be affected? So think about it in that perspective as well. So they're taking benefits away from the taxpayers. But remember how those benefits actually it's an incentive to buy real estate. It's not an incentive to buy real estate anymore. It's an incentive to give to charity. That's not really there anymore. So just keep that in mind. Yeah, you're right. It was designed so more people can take the standard deduction. Fewer people are itemizing. So just think of the unintended, maybe intended consequences in that case. Let's do, the next question, just like what's, like with these questions we're going to do them a little bit later. Again, I want you to do it at home. Salary is considered income. Interest from corporate bonds, income. Alimony is still income. I'll go over the alimonies, and it's not income. From 2019 going forward, that's not income. Contributions to a traditional IRA, they get a deduction for AGI. So this is going to be a deduction for AGI, not an itemized deduction for AGI. Gift from parents, not income. Short-term capital gain, that's income. What about this money that he lost in an office pool? Not a deduction, right? Personal loss. Well, you can make an argument that it's a gambling loss, but you have to have gambling income to deduct gambling losses. Again, I want you to do the same analysis here as well. Again, salary, that's income. This is interest from municipal bond. This $3,000 is not income. Life insurance proceeds, not income. Inheritance, not considered income. What about this loan over here repaid by Aiden to him in 2019 and 2013? The cousin finally paid him back in 2019. Is that considered income? No, maybe. Remind me to ask to talk about this more detail next week. Generally speaking, no. So generally speaking, that's not considered income. And then over here, itemized deductions to standard. Most likely, it's going to be the standard is going to be higher. Again, we'll walk through the computations next week with those. I want to do one with claiming somebody as a dependent. 32. Yeah, this one's this is a good one. I think this is a good one to end with today. 32. So this is for 2019. So this is the Tax Cuts and Jobs Act. So the question is, can you claim them as a dependent, and what credit they can get? And when you're thinking about a dependent, I want you to also tell me or start thinking qualifying child test or qualifying relative. Again, qualifying child, that's relationship, age. Again, age is under 19 or under 24 and a full-time student. So just keep that in mind. Self-support and home test. And then we have qualifying relative. Gross income test under the 4,300. Support, again, more than 50% support by the taxpayer. And then the last test, relationship or member of the household for the whole year. So remember those tests. Qualifying child test always goes first. So let's look at these fact patterns. So Leo and Amanda, they're married. They provide more than 50% of support of their kids. So the kids do not provide support of themselves. So self-support test is met. All right, Elton. Let's look at Elton. Elton is age 18, and also Elton earned 4,500 from transportation for elderly persons with disabilities. Trista earned $5,000 for tuition for law school. The $5,000 is used for tuition. Trista, by the is 24. All right, Elton. Is Elton a qualifying dependent? Under what rules? What do you guys think? Or under 19? Mm-hmm. Yes. So everybody okay with Elton being a dependent on the qualifying child? Under
Yes.
19?
Yep.
Okay, what about Trista on the other hand? Trista is not a qualifying child, right? She's not under 19 and she's not under 24. Well, let's go on the qualifying relative. Qualifying relative, gross income, support, and she is related to the taxpayer. Gross income test. The scholarship is excluded from gross income if it's used for tuition. So the gross income test is met, right? So in that case, qualifying relative. Everybody okay with this? One qualifying child, one qualifying relative.
Mhm.
Now, in terms of those tax credits, the $500 credit or the $2,000 credit? Remember, $2,000, the dependent has to be under 17. So $500 credit for each one, right? $500 credit for Elton and $500 credit for Trista. So $500 for each one.
Okay.
Okay, letter B. Audrey, age 45, is divorced. She maintains a household in which, this is pretty tricky, which she, her ex-husband, Clint, and her mother, Olive, live and furnish more than 50% of the support. Olive is age 19 and fine. Think about your in-laws. Your in-laws are always going to be your in-laws. So sort of think of it that way. Just think of it in that respect. With your, as far as your, well, hold on. I'm not done with the. Well, Olive is possibly dependent. What about Clint, the spouse? She maintains. Audrey does. Okay, here. Audrey, age 45, was divorced this year. She maintains, okay, she maintains a household. Did you start reading there where it says she maintains a household? And I guess maybe the sentence structure. I agree with the sentence structure. She maintains a household. That's the part where, that's where it leads. She maintains a household in which her ex-husband, and her mother-in-law live. And I would have put another comma, and then furnishes more than 50%. Yeah, that's the sentence structure. I guess you could put a comma there. Okay, so on that fact alone, it's not Olive that's providing the support. It's Audrey. Audrey supporting Clint and Olive. Clint is the ex-husband. What do you guys think? Can she claim her ex-husband? No. Well, not the year of divorce. The year of divorce, you cannot claim your former spouse, even if they meet the test. Not the year of divorce. Any subsequent year, perhaps. So Audrey cannot claim Clint. Can Audrey claim the mother? Well, let's say that. Let's go over the rules. Gross income test. Going to your question, gross income test is 0. Olive has no gross income, right? It doesn't mention again. Olive has no gross income. That's not considered gross income. Nope, considered gross income. It has to be taxed. The same reason why scholarship is not considered gross income. It has to be taxable income. Yeah, she's receiving Social Security. That's barely enough to even support yourself. So even in respect to gross income, it's not even an issue here. So no, not an issue. So she does qualify on the gross income support test, and she's related and a member of the household. So both tests are met. Clinton, nothing for Clinton. $500 credit for Olive, right? That $500 credit for other dependent. How about the following year? Year of the divorce, she can't claim her ex-husband, right? What about the next year? Can she claim her ex-husband? Yes. The subsequent year, assuming the tests are met, qualifying relative tests, possibly yes. Next question. Letter C and D get a bit tricky. Remember, standard deduction amount is 4,300. So standard deduction is 4,300. All right, so Crystal, age 45, furnishes more than 50% of the support of her married son, age 18, his wife, 19, who live with her. During the year, Andy earned 8,400. All parties live in Iowa, common law state that is relevant. Can Crystal claim Andy? Is Andy a qualifying child or qualifying relative? What do you guys think? Andy's a qualifying child, right? Relationship is met. Age test under 19 is met. Self-support. I doubt the 8,400 is enough to support himself, right? And again, if you look at the language, Crystal supports more than 50% support. So the dependent is not supporting himself. And they live at home. You can claim Andy on the qualifying child, right? What about the wife? Qualifying relative, right? What's a qualifying relative? Gross income test. It has to be less than 4,300, right? Support. The taxpayer is providing more than 50% support, right? The last test, relationship or member of the household. Well, both of them are met. Relationship test is also met, but the member of the household has been met as well. So both dependents, right? $500 credit for Andy, $500 credit for Paige. Letter D. Assume the same set of facts, except this is Washington, a community property state. So he earns 4,000. Oh, by the way, this is for 2019. He earns 4,200. He earns 4,200. She earns 4,200. I lied to you about the exemption amount being it's 4,300 2020. It's 4,150. 4,200 last year. Let's go with 4,200. It wasn't more than 4,300. Actually, I'm pretty sure it was 4,150. Actually, let me go to the book real quick. But remember, they made 8,400 in a community property state. They're splitting the income. What is the exemption in 2019? Here it is. Oh, we're going to use these tax rate schedules next week. This is what I'm going to provide you when you take the exam. Again, you're not going to be able to use a tax table. You're going to have to use these tax rate schedules. We'll go over that next week. So we're looking at 2019. So 2018 is 4,150. 2019, it is 4,200. Okay, so 4,300 in 2020. All right, go back. So what year were we doing it for? We were doing it for
29.
20, okay, so it's 4,200. So it has to be under 4,200. So we're splitting the income 8,400 in half, 4,200 each, right? Andy is still the dependent. Andy's still a dependent. Can Paige be claimed as a dependent? No. Again, it's under the gross income. In that case, it's exactly the gross income. So Paige cannot be a claim as a dependent. In that case, only the son can be claimed as a dependent because of the gross income test. Again, even though we're not using this as a, a computation, again, it even highlights it here. The personal exemption is used for other purposes, and the provision, again, not used for computing the tax, but you apply it everywhere else in the Internal Revenue Code. So that's still applicable. Okay, any other questions on this question? All right, there was another question. I think that's it for today. Any closing questions? Anything you guys want to talk about? Questions before we leave today? Anything? No questions? At all? You guys have no questions. That's not good. I want you guys to participate. I want you guys to ask me questions. Dan, you're still here, right?
Yep.
Franklin, are you still here? Franklin, you're gonna have to talk to me. I see you, but are you there? All right. Hannah, are you there? You're still here, right? Hannah?
Yep.
Margaret? Yeah, everybody's still here.
Yes, I'm still here.
Mia, I still see you. Who left? No, a couple people. Well, one person left, I think. Oh, it happens. Yeah, make sure you take notes, get notes. If you have any other questions, ask me. No questions? You have no questions at all? So that could be a good thing. That means you guys really understand the material, right? Again, here's where you guys should be asking questions. As you're reading the material, start taking notes, start writing down questions that you're gonna ask me. The only way I know that if you don't understand the material, one of the things that's a bit challenging doing it this way, if we were live in class, I can at least ascertain if you're understanding the material or not. I can't make that assessment through Zoom. So I'm just relying on you to participate or not to participate. So again, I want to emphasize this, that you got to participate. So everybody has to participate. So just keep that in mind. Any questions? Any other questions? No questions? At all? All right, so this is what we're going to do next week, or next session, I should say. As I mentioned before, this is, this week is going to go by fast. I mean, this semester is going to go by fast, so just keep that in mind. It's an accelerated term. You should have already purchased a textbook. The quiz is coming soon, so just keep that in mind. I'll give you a practice quiz. I'll email you the practice quiz on Wednesday. We'll go over that next Monday. And the next week, you'll have your first quiz. That's going to be available on Brightspace. So that's going to be available soon. Again, in terms of the material, again, it's going to go by, fast. Next session, I'm going to post the lecture notes for gross income and gross income exclusions. So we're going to start wrapping these two or this chapter at least next session. So on Wednesday, we're going to at least be done with this chapter. We are going to start covering chapters 4 and 5, and we're going to cover 6. Again, we are going to move, fast. So it's very important that you get the textbook or get access to the textbook as soon as you can. No questions at all?
I have one question about the quiz. Is it going to be due on Wednesday or be made available on Wednesday?
No, it's going to be made available the day before Wednesday. It's due Wednesday. So
Okay.
you can either take it it's going to be available Tuesday and Wednesday. So you can take it on Tuesday or you can take it on Wednesday, as long as you complete it before 5:30. And it's a time quiz. So the latest you can actually take it, if you think about it, would be on next Wednesday. You could start taking it at 5 and be done at 5:30. You'll meet the deadline. But if you started at 5:30, you will not meet the deadline. Because again, it has to be completed by 5:30. So just keep that in mind. 5:30 next Wednesday, one of the first things we're going to go over is the quiz. We're going to go over the answers of the quiz. See what you did wrong, and then I'm going to make available the answers to the quiz, so that way you can see what you did wrong. In terms of the quiz, you can't cheat from your fellow student, fellow classmate. Everybody's going to have a different quiz, so just keep that in mind. Do not ask. Well, you can't even text each other, but let's say you were trying to ask one of your fellow classmates, "Hey, what's the question? What's the answer to question number 1?" Well, it's going to be different questions for each person. And even the questions itself, it's randomized. So that's going to be different. So very, very difficult to cheat. So just keep that in mind.
How many questions?
For multiple choice, it's going to be about 10 or 12 questions. Multiple choice, pretty straightforward. The midterm and exams, it's less questions. So think about this for a second. The multiple choice questions are about 10 or 12 questions. The midterm and the final, about 7 and 8 questions. So what should that tell you about the midterm and the final? Does that mean the questions are going to be easier for the midterm and the final? No. The midterm and the final questions, they're more comprehensive. They're more cumulative. It's not just one part of the question. I'm not just going to ask you for, one part of the question. I'm going to ask you for the whole judicial system. I'm going to ask for you to compute the taxable income. I'm going to ask for, filing status and exemptions, plus the different credits that they can claim. So again, it's more inclusive. Whereas the multiple choice question is just going to be one question, one answer. That's it. But different format for each one, and that's covered in more detail if you read the syllabus on how I'm going to, test you. Both will be available on Brightspace, and they're both timed. Okay. Any other questions? No questions? All right, I have somebody just making a... Matthew, did you record it, Matthew? Yeah, thanks. So Matthew has an announcement for everybody. Thanks, Matthew. He recorded it. Yeah, feel free to share that. Again, I'm not against you recording it. I just had a couple of challenges saving it from my end, trying to find the settings. I'll figure it out. But again, since this is new to me, I'll figure out a way to share it. At the very least, I'll do my best to at least share the more like the right around midterm and right around the final. At least those two, I would try to share those two. But again, you guys are more than welcome to record it if you have other systems in place. Thank you, Matthew, for that, and just share it with everybody. I believe you can share it through Brightspace if you attach your the link. Just email everybody.
Oh yeah, I might be able to put it through Brightspace as like a forum link or email people.
Yeah, there you go, and just send it that way. That would help. Again, at the same time, I do want everybody to take notes. So this is like we're in class. So just keep that in mind. We're in class, but you're still taking notes. I want you to participate. Any questions? Matthew, did you record last week?
No, I didn't. And I missed about the first 15 minutes of today's class, getting everything set up and not missing too much of the lecture while I was doing it.
Well, yeah, the first part, we went over a lot of stuff from last week. So Pretty, straightforward. Okay. So if nobody had, I think we ran out of time. Again, going forward, we are going to cover gross income, more detail. That's going to go by fast, and then we'll go over deductions. Yeah, it's going to go by fast, and then before you know it, the midterm would be at the end of the month. So it is going to go by fast. So on that, I need somebody to make a motion to end the meeting, and I need somebody to second that. Anybody want to make a motion to conclude the meeting?
Motion to adjourn.
Okay, I need second.
Second.
Thank you guys. I'll see you guys next session on Wednesday. Have a good one.
All right.
Thank
See
you.
ya. Thank you.
Thank you. Bye, guys. Thank you.
Okay,
Bye.
bye-bye.